Hey everybody, Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, tax strategies for 2024 and beyond. In this video, I am going to go through some of the key tax strategies involving using an IRA or 401k to help you from a tax standpoint for 24 and for future years. So I'm going to try to keep this video at around 20 to 25 minutes. I'm going to be mindful of people's time, respect people's time. I know there's a lot of other things to do during the day than go through tax strategies. So I'm going to try to be as quick as I can, but still want to give everyone all the details they need to become a better, smarter, and more successful tax retirement investor. So just some info about me. You know who I am. Tax lawyer. I've written 9 books on self-directed retirement accounts. I have a master's in tax law. Worked at some of the largest law firms in the world. So this is my area of expertise. So before we get into some of the tax strategies, let's talk about some of the key self-directed vehicles. And the main vehicle for using a retirement account to invest in alternative asset investments like real estate is the self-directed IRA. If you have an IRA at a traditional institution like Fidelity or Schwab, they're not going to let you do alternative asset investments, right? So the self-directed IRA, which was created along with the IRA in 1974, the word self-directed IRA is not a legal term. All it means is an IRA that lets you do alternative asset investments, okay? And then you can do what's called a checkbook control IRA, where what that means is an LLC is just imposed underneath the IRA, and the LLC makes the investment directly into the alternative asset, such as real estate, which the LLC gives you speed, control, and limited liability protection, along with some privacy. And the other key vehicle is the solo 401k. I'll talk about the solo K and the 401k, where you can maximize retirement savings if you're self-employed, you have a business with no full-time employees other than yourself or a spouse. You can put away up to $69,000 if you're under 50 years old for 24, $76,500 if you're over 50. So we're going to go into some details on that, but just wanted to cover the 3 basic strategies with everyone now. So let's keep going. The most important part is, hold on, I'm just trying to work the podcast, the video. I've got a new format here and trying to get the, hold on a sec, sorry. Trying to move the PowerPoint. Here it is. Sorry. Okay. So let's talk about the self-directed IRA. Sorry about that. Let's talk about the self-directed IRA versus the 401k. The max contributions for the IRA are obviously smaller than the 401k. The IRA is $7,000 if you're under 50, $8,000 if you're over 50. The 401k, as I mentioned, is $69,000 or $76,500 if you're over 50. The key of the IRA, and why I want to focus on the IRA, is it's obviously the most common type of retirement account. And if you do a traditional IRA, you can put away $7,000 or $8,000, but you get a tax deduction for the amount you put in. You can do a Roth IRA, which we'll get to in a moment, and that is an after-tax account. So it's a strategy in terms of sheltering income from tax, not from a tax deduction standpoint. Same with the solo K. You can do $69K or $76,500 if you're over 50. The $69K and the $76,500 can be bifurcated into pre-tax or Roth, and you can then obviously make the determination on whether you're focusing more on deductions or focusing more on generating tax-free growth. In terms of what you can and cannot do with a self-directed account, there's only 3 things you can't do. You can't buy life insurance, collectible, and anything under $49.75, which is essentially self-dealing, conflict of interest transactions involving your retirement account and a disqualified person. So why do you want to invest with an IRA or 401k? Since the whole purpose of today's video is tax strategies, well, it's deferral, right? That is the name of the game. With an IRA or 401k, when you buy an asset for $100 and you sell it for $200, all the gain goes back to the IRA without tax. That's known as deferral. compounded returns. Your money doubles every 8 years, assuming a 9% rate of return. Power of 72. Okay, so that is the main advantage, and why, if you look at annual tax strategies for maximizing tax benefits, whether it's sheltering income and gains from taxation or for generating deductions, any good attorney or accountant is going to focus on the retirement world. IRAs and 401ks. It's the easiest source of deductions and the most simplest way of sheltering your income and gains from taxation without having to get into any complex tax shelters. So we all understand the power of deferral. Some people can't believe it, right? When you talk about IRAs and 401ks, they have a hard time grasping the fact that you could buy an asset and not pay any ordinary income tax or any capital gains tax. So that's the case. The beauty of deferral is you do not pay any income and gains generally when the money flows back from your investment into the retirement account. So I mentioned the key advantages, right? This is how smart people save. This is how people generate real wealth, is they take advantage of the system. They take advantage of mathematics, simple algebra, not even calculus, right? This is simple math. Your money is going to grow faster when you don't pay the government tax on the income and gains. Pretty simple. Okay, and then the only thing you need to decide on is, you want a deduction, or do you want to wait till you're 59 and a half and the Roth's been open 5 years so you can shelter all the income and gains from taxation? So the most popular self-directed strategies, as I mentioned, is either a pre-tax or Roth IRA, a backdoor Roth conversions, using real estate with leverage in a 401k without paying what's called tax on UBIT, the mega backdoor, the loan, and the 60-day IRA distribution. And I'm going to tackle each one of these strategies in today's video. So as I mentioned, one of the most common questions I get on a daily basis is, Adam, should I do a pre-tax IRA or should I do a Roth IRA self-directed? And there's no right or wrong. I've written a book, In Roth We Trust, In God We Trust, In Roth We Prosper. I've written 9 books and tackled this topic. I probably do 30 calls a week with clients and potential clients on whether they should set up a pre-tax or Roth. There's no right answer, but here are the options you need to consider. Right, your age, right? A Roth is more powerful at age 25 than 75. More opportunity to shelter, right? And that goes to just simple mathematics. Your tax bracket now and your tax bracket when you retire. If you expect to earn a lot of income when you're in your 70s, then conversion may have more power than if you probably are going to be playing golf or lying on a beach and just having a very minimal amount of income when you are over the age of 70, 3 years old. At that point, a conversion maybe does not make as much sense, since your tax bracket will be low when you need the money, right? Are you an investor, right? What's your expectations? Are you looking to hit home runs? Are you going to just be in 4 or 5% simple treasuries? How much growth do you want to shelter? Okay, so all that matters, right? And the other day, I spoke to someone, maybe on Tuesday, and this gentleman made about $1 million. He was, I think, 70 years old. And he's like, Adam, I keep listening to your podcast and watching your videos, and you keep talking about conversions. Talk to me, explain to me why I shouldn't do a conversion. And I said, okay, well, number one, you're 70. I said, number two, can you pay the tax? It's like, maybe, maybe not. I can do it over the next 5 years. I said, okay, cool. I said, thirdly, are you an investor? He's like, yeah, I'm pretty good. I do hard money loans. I get about 10 to 12% a year. I'm a pretty good investor. I said, okay, what's your income going to be in the next 5 years? He's like, well, I'm kind of semi-retired. I'm probably going to be fully retired in the next year. And I'm going to need money to live, but I'm not going to be a high income earner. And I'm going to be, in a bracket that's under 24%. So I said, listen, why give Uncle Sam the money today? It may not make sense. Right? If you have a lot of losses that you can use to offset the income, maybe. But if you don't, you may just want to stay the course, and that may be your best opportunity. And those are the kind of conversations I have. There's generally no right or wrong, right? So I can't tell someone, yes, do it, or don't do it, right? We have the conversations, we go through some of the factors to consider, and then ultimately, the client's going to make that decision. But these are some of the factors to think about. Obviously, if you have $1 million of net operating losses, then you can use those losses to offset the tax on the conversion. So the pre-tax IRA, who can make them? A lot of people think anyone can make a pre-tax IRA. It's not the case. It's based off your income and whether you have access to a 401k at work. If you do not have access to a 401k at work, even if you make $1 billion a year, you can do a pre-tax IRA contribution. If you're single and have access to a 401k at work and you make more than 87k, you cannot. If you're married, filed jointly, okay, and the spouse making the contribution is covered by 401k at work, even if they don't participate. You make more than 143, married, filed jointly, you can't do a pre-tax IRA. You can do an after-tax IRA, but why would you, right? Only reason to do an after-tax IRA is to just do a backdoor conversion to Roth. And then if you're married and your spouse is making the contribution and not you, if you guys make more than 240, you can't do a pre-tax IRA, or your spouse can do the pre-tax. So just something to keep in mind. Doesn't mean you don't have options, you just do. What's your option? It's called the backdoor Roth. Starting in 2010, there's no income limitations for Roth. Anyone could do a Roth, even if you make $100 million a year. So yes, I'm about to say there is an income limitation of 161 if you're single, or 240 if you're married, filed jointly. That's actually not true. Because of the backdoor Roth IRA, even if you make $100 million a year, you just make an after-tax IRA contribution and then convert it to Roth. One thing to keep in mind is if you have other IRA funds, pre-tax IRA funds, there is a formula to determine how much you can convert without tax. But the option is to get into Roth if you really, really want to, especially if you don't have any other pre-tax IRAs outstanding. You can just do an after-tax IRA each year, even if you make a lot of money. So distribution rule, something to keep in mind, right? If you have a pre-tax IRA, if you pull the money out before 59.5, tax 10% penalty. If you pull it after 59.5, you're going to pay tax, no penalty. And if you're over 73, you have to do what's called an RMD, which is approximately 3% a year. Roth IRA contributions are after tax, they're not tax deductible. So if you're looking for deductions, the Roth IRA is not your answer. If you're looking to shelter income from tax, the Roth is the best tax solution out there. The key is this: the contributions you make, you can pull out anytime you want tax-free. The earnings on the contribution, you need to be 59.5 and the Roth open at least 5 years to pull the money out. If you pull the money out before, you don't satisfy the 59.5 and the 5 year, you're going to pay tax and 10% penalty on the earnings. Contributions, you can always get out anytime you want. Conversions. Just spoke to someone on the phone maybe 20 minutes ago. He's owned a piece of property. He paid $250. He had some debt on it. And now he needs to get out of it. He thinks the property's worth less. And he's like, what do I do? Should I buy it back for myself? I said, hey, no, just do a Roth conversion. He's over 59.5. When you do a conversion, you pay tax on the value. He said the property's worth less now because he lost a major tenant. He had some issues with the building. And I said, okay, do a conversion. He thinks he can convert his equity piece from 250 down to like 125. I said, do it. And he goes, I also have some losses I can use to offset the conversion. I said, amazing. So now he's able to get the pre-tax into Roth. So he now can control that building tax-free. He's already over 59.5. He has to wait 5 years to sell it for a gain, but whatever he paid for it, he can just pull out. And he has potential when the building comes back to life, interest rates drop, he gets a tenant, he can shelter all the appreciation from tax. When you do a conversion, you pay tax on the fair value, not a 10% penalty, but you also can get a discounted value for lack of marketability, minority. So there are opportunities through an appraisal mechanism to get a lower valuation for the conversion. This is a really important tax strategy that a lot of people leave on the tables. Oh, I have access to a 401k at work. I'm good. Oh, I can also make IRA contributions? Yeah, you can. Remember, backdoor Roth IRA. Even if you make $1 million a year as a lawyer or a banker, you can still do a Roth IRA. It's not tax deductible, but you're getting more money from your savings into a tax sheltered account. So even if you were going to invest that 7 or 8K in your personal savings account, just do it in a Roth because you'll shelter all the income and gains from tax. Pre-tax IRA, you just need to look at the income thresholds. If you had no access to a 401k, you can do a pre-tax IRA of 7 or 8K. If you have access to a 401k at work, depending on if you are making the contribution or a spouse, you'd have to look at the contribution limits, that I mentioned. Here they are, right? It's 140, it's 143 or 240, depending on who's making the contributions. So just keep that in mind, but don't leave money on the table, right? The Roth is always there. Even if you have access to a 401k and you make more than the 140 or 240, you still can combine the IRA and 401k value by doing the Roth IRA and doing the pre-tax or Roth 401k contribution. So you can contribute for 2024, you can do 23K or 30,500 if you're over 50 in a 401k pre-tax or Roth. And then you can combine that with 7,000 or 8,000 in IRA or Roth IRA, depending on your income level, and just put extra money into your IRA. A really cool strategy for 2024 and beyond is if you are self-employed. So let's say you are a real estate developer, you have no full-time employees other than maybe yourself or a partner or spouse. A spouse is not deemed an employee for ERISA purposes, and you want to buy real estate and you want to use leverage, right? Every real estate investor in the world wants to use other people's money, leverage. So you can do it with a 401k. Like an IRA, the loan must be non-recourse, so you cannot personally guarantee the loan, but if you do it in a 401k, you'll exempt any of the gains from what's called a UBIT tax, unrelated business income tax, which applies to IRAs that use leverage, a loan, to buy real estate. That tax can go as high as 37% on anything above 15K in net profit. So if you do it in a 401k, because of the exemption under 514c9, you could eliminate all the income and gains, the taxation, by using leverage to buy real estate by just simply using a 401k versus an IRA. So just a simple move from the IRA to 401k, assuming you're self-employed, you have a business, no full-time employees, I could eliminate any potential leverage tax under the unrelated business taxable income regime just by going into the 401k versus the IRA. And you also have the ability to make high contributions in pre-tax or Roth, 69K or 76.5 if you're over 50. You can borrow up to 50K, which we'll get into the loan feature. So some really cool stuff. Along with an amazing, one of my favorite little known tax strategies is called the Mega Backdoor Roth 401k. So I'm a huge Rother. I love the Roth. All my retirement savings are in Roth. Why? I'm 40, late 40s, and I feel that I could, even if I'm not the greatest investor in the world, over the next 20 or 25 years, the tax-free income, the income I'm going to shelter from tax is going to be far greater than any deductions I could generate in the current year. That's my risk, and that's also going to be my reward for just hopefully being a good investor and being patient and kind of basically not focusing on a current deduction and being a little bit more long-term thinking and trying to shelter all my future gains from taxation. So now the Mega Backdoor Roth, in 2024, Roth IRA will give you $7,000 or $8,000 if you're over 50. A Mega Backdoor will let you go to $69,000 tax-free Roth. So let's say you have a business, you make $80,000 in Schedule C, or it's a C Corp, S Corp partnership. So C or S Corp, you have to look at your W-2, not the profits of the business, the W-2. For a sole proprietor single member LLC, you have to look at the net Schedule C. So you made 80K, you don't necessarily need all the money. Maybe it's a second job, it's a gig. You can take up to 69K in 2024 and just dump it into a Roth and just invest it in a Roth. So this way all the income and gains generally flow back to the Roth tax-free, right? So you take advantage of compounded returns. You take advantage of sheltering the income. It's literally the best legal tax shelter out there. And why I love this so much is a Roth IRA is great, but it only gives you $7,000 or $8,000 if you're over 50. This is going to give you 69K, almost 10 times. So it's an unbelievable opportunity if you're a Rother. The one thing is you got to be in a solo K. Most 401k plans, if you work at Tesla or IRA Financial, you may not be able and eligible to do it because of the fact that they're subject to ADP and ACP, which is a deferral percentage, contribution percentage, ERISA tests. And if not enough employees are doing this Mega Backdoor, the plan will be top heavy. It's going to fail the test, and you're not going to be able to do it. If you're in a solo 401k, it's not subject to ERISA, so you're going to be able to get this done, which is awesome. Okay, the plan must include the option, as I mentioned, and it's very easy. You just do an after-tax contribution, convert it to Roth. We do it for you. We'll set up bank accounts with Capital One for you, so you can have a pre-tax bank account, an after-tax bank account, a Roth bank account. It's all included, no additional costs, and we'll help you do the conversion. We'll even report it on the 1099-R. There's no tax, but you still need to report it, and it's literally the best legal tax shelter out there. And you do this for 5-6 years, you're gonna have multi-millions in your retirement account when you retire. Now, the loan is a great tax strategy for 24 and beyond. The most you can borrow is $50,000 or 50% of your account value, whatever's less. So if you have $100K in your 401k, you can borrow 50. If you have 20, you can borrow 10. And I have some people that just set up solo Ks just for the loan. Hey, I need money for my business. I got to pay credit card debt. I want to go on vacation, whatever it is. You can use the money for any purpose. The beauty is now, as of today, September 5th, 2024, prime rate is 8.5%. That will go down as interest rates drop. So on one side, your interest payments are higher. It is a 5-year loan, straight line, not a balloon payment loan. The downside is the interest payments are bigger. If you do it weekly, bi-weekly, monthly, or quarterly, you can't go and expand it beyond quarterly. But the nice thing is your money is getting an 8.5% rate of return. So you're getting tax-free, penalty-free use of the money, and you're getting 8.5% rate of return on it because the money guaranteed, right? That's the prime interest rate. Guaranteed it's going back to your 401k without tax. So you get tax-free, penalty-free use of the money to do whatever you want with it, and then your plan's getting 8.5% on that money, and that's growing tax-free back into your plan. So again, I have a lot of clients that are just setting up solo Ks just for the loan feature. They're like, yeah, I'll do some other investments, but I need the 50K. I got to get this done, and I'm okay paying my plan back 8.5%. Like, why not? That's money in my pocket. That's literally guaranteed rate of return. Another cool thing is the 60-day IRA loan. So not a lot of people realize this. If you're in a situation where you just need some liquidity, you're like, hey, I'm short on some money, I'm getting a bonus payment, or this guy owes me money, I just need to come up with some cash for the next 20, 30, 40, 50, 60 days. Once every 12 months, you can liquidate your IRA or take money out of your IRA without paying tax or penalty. But you got to return that money within 60 days. And if you don't, it's treated as a taxable distribution, subject to income tax if you're over 59, or plus 10% penalty if you're under 59.5. So really interesting option that's there. It gives you some flexibility. A lot of people don't realize it, and I can't tell you how many people just take distributions and don't realize that they actually could have done a 60-day. It's once every 12 months, not once every year, once every 12 months, kind of floating, rotating calendar schedule, but it gives you some flexibility. So let's say you have 100K in your IRA, you're like, man, I need 20K just for 30, 40 days. You can do this and get tax-free, penalty-free use of the money. Another way to get access to the money without penalty. So hardship distributions, you can get access to your IRA money, but you still have to pay tax. You don't pay the 10% penalty. And obviously there's this tough stuff. You got to show hardship. If medical expenses above the 7.5% of your AGI, qualified higher education expenses. If you're buying a first-time home, up to 10K. I wish they would make that higher. This 10K has been in the code for, 30 years. It's stupid. Prices of homes have gone up so much in the last 5-10 years. It would be nice if they added 30 or 40 or 50K, but it is what it is. And if you're a qualified military reservist. So just again, the whole point of today's video is these are tools in your tool belt, right? Things that you should be thinking about, whether it's pre-tax IRA contributions. And this is a good slide to end with. Is this. This is the most popular strategy. So if you're going to kind of take one slide and copy and paste this, or just take a picture of it in your mind, or just a picture of it from your phone, this would be the page. These are the strategies that you should be thinking about throughout the year, but especially, we're towards, the back end of 2024. This is the key stuff, right? I'll do another video about non-retirement tax strategies, whether it's charitable deductions or accelerated depreciation or some other cool stuff you can do. But I wanted to start with this because, again, this is dear to my heart. This is, I think, not only what could help you in 24, but definitely is going to help you beyond. I've said it a million times, I'm saying it again, the retirement system is rigged in our favor. It's literally like the government literally like is giving us a path to generate tax-free millions of dollars. It's just taking advantage of it. And this is how you take advantage of it. You make contributions, whether it's pre-tax or Roth. If you make too much money, you can still backdoor Roth it. If you have a lot of pre-tax money, but you want to go Roth, you can Roth conversion it. If you are into real estate and you want to supercharge your returns, if you're self-employed, you can do it tax-free by doing a solo K. If you are self-employed and want to dump up to $69K in a Roth, you can do it through the mega backdoor. You could get up to $50,000 or 50% of your account value, whatever's less, tax-free use of the money through a loan. And the good news is you're paying yourself back at least an 8.5% rate of return. And if you just need some short-term liquidity from your IRA, it's there 60 days, once every 12 months. These are some really good strategies that you should be thinking about when times are good, like making contributions, but also on difficult times, like hardships, right? Like the 60-day IRA distribution, like the loan, right? So you have, this video is there to give you, I think, some offensive strategies when you want to put away as much money, you want to shelter as much money and gains from taxation, but I think also some really good defensive strategies where you can use your IRA or 401k to protect you and your family in kind of a downturn, whether it's through a loan, a hardship distribution, or the 60-day IRA distribution. So that's today's video. I'm trying to keep it short. Everyone's telling me, Adam, your videos are great, but they're long. I only have 10, 15, 20 minutes. I'm busy and I get it. Like, I know when I watch a video, sometimes if I see more than 5 minutes, I want to turn it off. I just get excited. Sorry. I love talking about this stuff. My bad. Otherwise, have an amazing rest of your day. I hope you enjoyed the video and I hope to see everyone again on the next video.